Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
All right, I think I'll just start. I see some students coming to the lecture, and it looks like you do have some confidence about the recording system, but I don't have confidence in it. Now they have changed the configuration again, so I would prefer just standing here instead of walking down and up the steps. It's quite some risk for me. So this week, we're going to talk about some real stuff. The methods of asset allocation. In the past several weeks, we have been really critical of the problems of the modern portfolio theory, like it's a single period model and it doesn't incorporate any changes of investors' objectives, their circumstances, or it does not incorporate the dynamics of the investment opportunities. These are some realistic problems we should consider in asset allocation. So now we're going to move on to some the methods that you can actually apply in practice in addition to the mean variance optimization process. So again, these are still just models or methods, the technical tools we can use in financial investment decisions. Not any one of these methods are perfect, or not any one of these methods is actually can solve all of the problems in the reality. So we're going to focus on the first several methods. So we have spent a lot of time discussing mean variance optimization and how it cannot be used as a decision tool. Instead, it's actually an analysis tool. And today, we're going to focus on liability-driven investing that will be applied to defined benefits funds. Hopefully, this will give you a start if in the future you're going to work for a pension fund, especially defined benefits funds. It's less popular now in Australia, but it's still very popular in the US, Canada, and several Asian markets. So even though for Australian students, probably there's a higher chance that you're going to work in the private sector, or you're going to work in like the mutual funds or private wealth management. But for a lot of international students, the discussion of the liability-driven investment method is still very relevant. Next one, we're going to talk about the benchmark relative. It's actually we had some exposure of calculating tracking error and using tracking error as a constraint in mean variance optimization to restrain your asset allocation, not be too dramatic, to make it more sensible. But here we're going to step forward and have a look at how the management of tracking error risk can actually improve the utility of private investors and some mutual fund managers. Next one is fundamental risk approach. So basically, this is mostly qualitative asset allocation approach. It's usually applied on top of a quantitative asset allocation method and try to improve your risk-return trade-off marginally. We'll come to the idea of economic diversification instead of just a diversification across the asset classes. The other methods like fill the buckets, two-stage approach, dynamic strategies, and scenario analysis, The ether is quite, it's more like a framework, a mental framework to present the entire investment universe, like the bucket, fill the bucket approach. It does not really produce the precise or exact asset allocation, but it's a framework that we can use, employ, in addition to other asset allocation methods. With two-stage approach, it's like a hybrid. We talk about the hybrid two-stage approach. The dynamic strategies, it started as a framework of managing investors' wealth over their entire life. So we're going to have some discussion on this and why this method is actually can mitigate or solve some of the problems of the standard mean variance optimization framework. And lastly, this scenario analysis. So for most of the methods we're going to discuss here, they are only looking at several outcomes. So several possibilities in the future. But scenario analysis will provide a much richer information of the possible outcome of your portfolio risk and return on different asset allocation decisions. So it's going to generate a probability distribution for asset allocation and portfolio outcome. It's tends to provide much richer information of the future outcome of your portfolio. But obviously, this cannot be done with Excel. So basically, for your assignment, we might apply the mean variance analysis, benchmark relative, fundamental risk approach, and you might get some ideas or apply fill the buckets, and very particularly, you probably want to apply two-stage approach. So these are very much more relevant methods for your assignment. And what I would still like to remind you, these are analysis tools. We don't make asset allocation decisions based on output from any of these methods. It's going to be your judgment still. So the discussion of liability-driven investment is going to be based on your reading of defined benefits and defined contribution funds in Australia, and your experience, your reading of the UniSuper webpage. So if you haven't done that, you probably will find it's really difficult to catch up. We have built up the knowledge in the pension asset management gradually from week 1. So up now, we're going to discuss the actual asset allocation methods that you can apply to a DB funds. So obviously, I don't need to explain what DB fund is. And you're going to have your total portfolio within your hands of your assets and your liability. Within your assets, you're going to decide the asset allocation in your assets in a way that you have the best shot to meet the liabilities. So they are the projected benefits, or you might consider this as a negative bond. So to some point of time in the future, you have to pay out some cash flow when some employees, they retire. And they might choose to take lump sum from their pension, or they might choose to take annuity. And sometimes the pension funds may provide the option of a combination of lump sum and annuity. So most of the members really have these options for their future arrangement of their pension. So for the DB fund manager, they have these ideas of managing the assets, especially here in this course, we deal with the asset allocation decision so that they have a higher chance in the future the benefits payment, the pension payments of members can be satisfied in the future. So that's the problem we're going to solve, or objective of a DB fund. The liability is not a choice variable for the managers or the board of the DB fund. So whenever the company decides to hire new employees, they put more members onto the liability side of the fund. For example, Telstra, it's not already close to new members. For instance, for the DB funds of government agencies, when they have more public servants on their payroll, they actually will create this liability for themselves, for the government agency to pay the pension in the future. So it's not a choice variable by the fund manager or the board of the super fund. So this will put quite some restraint on how the manager is going to manage the assets within their discretion. And the board of the super funds has the responsibility to write down the investment statement policy and their objective, their mission, and how they're going to evaluate the trade-off within the funds and how the manager's performance is going to be evaluated as well. So the board of directors of the super fund and the managers, they are the key people who are going to be involved in the management of super fund, of the DB funds and the asset allocation decision. With the DB funds, the quantitative risk measure is not going to be a tracking error or simply standard deviation of their asset or their portfolio. For tracking error, it quantifies the peer risk that is defined as how much you are deviating from the benchmark performance. But for DB funds, they do not have a benchmark at all. So they actually have that liability for every single defined benefits fund. They have their own restraint or constraint, the liability to meet. So they don't have a benchmark. So tracking error is not a relevant risk measure. And simply standard deviation of their asset is not actually a very, the most important quantitative risk measure, because the objective is to meet the liability payments in the future. So actually the likelihood, the probability that the funds fails to meet the liability is the risk. To quantify this risk, we use a measure of surplus or deficit in DB funds. So that's simply just the difference between the value of its asset and the value of its liability. The value of assets can be projected and based on your expected return of your portfolio. The value of the liability is usually not a straightforward discounted cash flow study, because when you think about the future cash flow payment, the salary growth is unknown, uncertain, and the number of members is uncertain. So their options when they retire, they're going to take up, like the lump sum, the annuity, or combination of lump sum and annuity, and the life of the members, they are all uncertain. So the valuation of projected liabilities will draw on a few assumptions and the techniques in actuarial studies. They have this actuarial study outcome of projected liabilities. Intuitively, they can be considered as the net present value of the future cash flow or the future benefits payment. So we are looking at the difference between the value of the assets and the value of projected liabilities to assess how the fund is positioned to meet its primary objective, meeting liability payment in the future. And also, it can be used as the risk measure, can be used as a funding ratio. So we may divide the assets with the value of projected liability. We look at how many times of your assets is over the projected value of your benefits. I have uploaded an example of Telstra DB fund on Watto. So if you have a look, right now they have a ratio a little bit over 1. And if you are interested, you might look at, in the past several years, the ratio is actually quite stable, a little bit over 1, but not really too much, like 2, 3, or 4 times. It's not a desired outcome if the funding ratio is 2 or 3 times for the shareholders of Telstra. And if you're interested, and you might go back to 2007, 2008, and 2009, have a look at the funding ratio of Telstra DB funds, you will find the net value, the difference, the first one, the difference of the defined benefits assets and liability changed dramatically over the 3 years. And the funding ratio as well changed a lot. Think about this, why it has changed in 2007, 8, and 9 in these 3 years. And so hopefully you'll find out yourself. Instead of telling you a number, you're going to forget about it very quickly. So these are the quantitative risk measures we normally use in managing DB funds or making the asset allocation decisions in DB funds. So how can the asset allocation decision will actually affect these two risk measures? So with DB funds, we have on the left the assets, that's the portfolio, that will require your input of asset allocation. And we're going to have several rough asset classes like equity, bond, alternative, and cash. On the right-hand side of the page, we have the liabilities. Actually, how your projected value of your assets matches the projected value of the benefits payment in the future will give you some indication how well your fund can meet can achieve your objective. So that's what we are going to achieve in the DB fund. How the asset allocation actually here are going to affect this, the match. So ideally, we want to have a perfect match so that the shareholders of Telstra, they don't need to make additional contribution into the assets, the left-hand side, and they won't be waste their money in the contribution carrying a large surplus of the DB fund. And on the right, the members of DB fund, they want to have sufficient funds in DB in their retirement pension payment to support their lifestyle they desire when they retire. And they're going to prefer an asset allocation to maximize the match between the value of the portfolio and the projected liability. But with shareholders, they want to find a balancing point. They don't want to contribute too much, but the expected return of the portfolio can look after the pension payment in the future. So there's a conflict. When the shareholders of Telstra, they probably can exercise this influence from their representatives on the board of the super fund by pushing the manager towards an asset allocation of more growth assets in equity or alternative assets, so that there will be higher expected return of the asset and there will be less contribution required from Telstra. But with the members of DB funds, they want security. They want to improve the chance that the pension payment are going to be made on it in the future. They probably want to push the company to have additional contribution into the DB fund, but have a more defensive or safe asset allocation. They will prefer some higher asset allocation into safe assets like corporate bonds, investment-grade corporate bonds, government bonds, and even higher asset allocation into cash instruments. So based on this understanding of different objectives, incentives from the sponsoring entity and the fund members, we actually, the final asset allocation decision of the DB fund is not usually a decision by either the employees or the company, the sponsoring entity. So that's why we need the board of directors of the DB fund. They're going to sit together and try to negotiate to find that balancing point of asset allocation that it still improves the chance that there will be less contribution made from Telstra, the company, But at the same time, there's a higher chance that the future projected benefits payout to members can be still satisfied. So typically on the board of directors of a DB fund, you'll find representative from the employees, even representative from the union, and also from the top executive of the company, Telstra, and sometimes they also include investment professionals, and sometimes, in the case of UniSuper, they have academics sitting as representative of employees sitting on the board. So they're going to negotiate and find that equilibrium asset allocation so that there's a higher chance that the objective of the fund can be satisfied, can be achieved, and the benefits, the welfare of members can still be looked after. What happened in the global financial crisis in 2007-8 is actually the growth assets, like especially equity and alternative assets, were hit hardest compared with corporate bonds, government bond, or other investment. So you will see a large, probably sometimes you will observe very much narrowed difference between the value of assets and projected liability. And also, you probably, over a period of time, 2 or 3 years, you're going to observe much higher volatility of this difference. So these are the risk measures we try to use to assess the risk of the fund, or in other words, the chance that the fund does not have enough assets to meet its liability payments. So up now we have some basic understanding of how DB funds are structured and how we measure the risk of DB funds. Next, we're going to talk about the method of asset allocation. So the method of asset allocation, briefly, we can follow a framework that we find a starting point, which is the minimum risk portfolio. Here, in the context of liability-driven investment, the minimum risk portfolio is not minimum variance portfolio. Minimum risk, here that risk, for DB funds is still the possibility not able to meet its liabilities. So the minimum risk will result in an asset allocation that you have a perfect or the best shot of matching between your assets and projected liabilities. So we'll start from there. That's usually how the members of the board are going to start their conversation. Okay, this is the best match. And from two different directions, we may allocate more funds into the growth assets, which is preferred by the sponsoring entity, and we're going to assess the chance of not being able to pay the projected liabilities in the future. And we're going to assess the surplus, volatility, and the funding ratio of the fund until to the point that the sponsoring entity and the members, the union, they all agree, okay, this is fine. So the minimum risk portfolio, that position as allocation is a starting point. The final asset allocation decision will experience a few rounds of negotiation, although it's not labeled as, okay, we come this board meeting, we're going to negotiate how we're going to come up with the investment decision. Actually, that's going to be, they're going to need opinion from the actuariist, some asset consultants, and sometimes they have their own internal investment staff. They're going to provide proposal, okay, at this level of asset allocation and the forecasted economic outlook and the future performance of the fund, how well we're going to meet the liability payments in future is like this. And then finally, the board is going to decide an asset allocation. Another approach is actually by matching the cash flow. Especially for closed DB funds, they will not receive new members, and they have the certain number of employees or members of the DB funds, for example, 100 employees, and you have very good idea the age of these employees and when they're going to retire. And probably for a lot of employees, you have very good information of the salary growth, like linked to inflation expectation and the years they have served the company or the government agency. So under these circumstances, you have much more confidence forecasting the future cash flow. So in this case, the DB fund can have an asset allocation that will match the future cash flow by actively managing their fixed income portfolio. So in this equation, or the matching of the assets and liability, now next we're going to look at the valuation of the liabilities. So for finance students, we have no idea how this is going to be calculated, but I'm sure a lot of students in this class who have the actuarial or statistical background, it's much easier for you to understand how you might make assumptions of the age, longevity of the members and the years they serve and salary growth expected in the future to have some very rough ideas of how you might forecast these liabilities. So the valuation of the liabilities can be intuitively considered as the valuation of future cash flow. So one important, probably the most important parameter in this valuation process is actually the discount rate. The discount rate, the decision of the discount rate is usually by the DB fund, In Australia, the usual practice is that they have looked at the duration of the projected liability. So it's a negative bond within your total portfolio. So they look at the duration of the negative bond and they find actually the bond or index of fixed income securities in the market with the closest match of duration. So if you look at the example on Watto, the Telstra, they actually have applied this method. They find an index of bonds with the closest match of duration for their projected liabilities as discount rate to value the projected liabilities. In the US, they apply another method, which is actually they use the discount rate calculated as the weighted average expected return of their assets. It sounds strange initially in the first place, but actually it's a reasonable estimate of discount rate because in the DB funds, you're going to use the cash flow, use the assets of your total portfolio to match the projected liabilities. So if both have the same expected return, or in the case of liability, the discount rate, you probably will have a very close match. Depending on the customs in different countries, so the discount rate can be decided differently. And it's very important as it's a parameter. It's an uncertain parameter. So it's an essential process in the asset allocation decision process that you do some sensitivity analysis. Especially right now, there are a lot of uncertainties in the market about the cash rate, the future monetary policy that will actually affect our expectation of the future equilibrium, real interest rate, and sometimes inflation as well. The driver of benefits projection. So there are a few factors that will be involved. For example, the years that the employee is going to work for the company. So the longer they work for the company, the higher benefits they expect to receive from the company. And also the salary growth, especially the average salary in the 5 years before the employee retires. And also the additional contribution made by the employee in the funds as well. Longevity as well, so the pension is paid to the member until the last day of their life. So all of these factors will affect your projection, the benefits projection. with these two parameters, we can do intuitively a valuation of the net present value of the projected benefits. The inflation is an important uncertainty actually in this valuation process. How it can affect your numerator and denominator differently. So with the numerator, we have the projected liability, and you may consider the future average salary of the employee when they retire, the longevity of the employees, and this particular salary is very sticky. Recall that from your first economic class, the economic indicators, they tend to move together, like the real economic growth rate, but salary growth is particularly sticky. It does not go up and down with other economic indicators as timely as other parameters. For example, purchasing manager index or other indicators that will reflect the economic development expectations timely. There's a substantial lag between real economic growth and salary growth rate, because usually the salary growth rate is stipulated in enterprise agreement. So if you are interested, you might do a Google search of the enterprise agreement negotiation between universities and the unions. So it's usually stated in my employment contract, in the next 3 years of time, every year my salary is going to increase like 2.5% as the long-term expected inflation. So no matter how the real economic growth rate is going to be in the next 3 years, no matter it's 1.5%, which is really bearish, or it's 3.5%, which is quite optimistic so far, my salary growth will be fixed as 2.5%. So the salary growth tends to be quite sticky. This will affect really the numerator of your valuation. The numerator is going to respond to inflation at a different rate as the denominator responding to inflation. The discount rate actually is determined, that's a nominal rate, determined by very much by the real interest rate. Or you may consider the discount rate can be a markup based on the risk-free rate as a premium when we apply the discount cash flow method. So that real interest rate is uncertain, and we understand the yield curve is a dynamic process. The yield from government bonds or the index from which we decide the discount rate tend to change, and also the yield curve can shift, can be inverted, and it's not a static estimate. So you have the valuation of numerator and denominator. They may respond to inflation and real interest rates at different rates. This will lead some substantial uncertainty of forecasting your projected liabilities. And that will actually decide that the projected liability, which behaves like a negative bond, has two durations. One duration is response, it's sensitivity to real interest rate, and another duration or sensitivity to inflation. Another factor that will actually important to decide the valuation of projected liability is the regulation. Here, the government will come into play how you might value your projected liabilities. So with this, that one, it's Australian Accounting Standards Board 119. So it's a guideline or regulation how you might value the defined benefits, assets, and projected liabilities on the balance sheet of an Australian listed company. If you're interested, you might have a look at how it's regulated. And also, if you have a look at the notes of the financial statement of Telstra, you will find very much detailed information how it's valued. the parameters and the uncertainties, and also the sensitivity analysis of the valuation. To implement the liability-driven investment, we're going to, now we have identified the measure of liability. We have identified the factors or parameters we're going to use in the valuation model of the projected liabilities. And next, we're going to characterize how the liability is going to interact with other assets of my total portfolio if it's going to be considered as a negative bond. So here on this, at this step, actually the mean variance optimization method can be applied. Again, it's not for asset allocation decision. Actually, it helps us to understand the interaction between the projected liability with all the other assets within the DB fund portfolio. So you might plot efficient frontier and have a look at the risk-return trade-off when you include the projected liability as a negative bond into your total portfolio. So that's one way to characterize the trade-off within your total portfolio and characterize the covariance matrix of your projected liability and all the other assets within your portfolio. Another method to characterize the interaction of the projected liability and the assets within the portfolio is by looking at different pairs of matches. And that's the a trade-off of how well the assets are going to match the liabilities by duration match. Telstra, DB Fund use this duration match, but they employ a quite simple, straightforward duration match of the nominal bonds. Actually, for DB funds, the projected liabilities, they have real interest rate duration and inflation duration. So that's why in a lot of DB funds, they have a very particular group of people working on the management of their fixed income portfolios. They're going to include inflation-linked bonds into their fixed income portfolio because inflation-linked bonds actually have two durations, real interest rate duration and inflation duration. So inflation-linked bonds, they actually provide a better match for DB funds to satisfy the liability of the projected benefits payment. How you might run this duration analysis is not required by this course, but you probably want to have some basic general understanding these double true durations involved in the valuation of projected liabilities. Another method to characterize the liability and the assets, the return of your portfolio, is by running a factor model. So with this liability, how can I characterize its response to economic growth or inflation? We can run a complex economic model to see the response or try to find the coefficients of how these economic factors are going to affect the valuation of the liability and assets as well. So this model is not a simple linear multivariate model. I understand you probably tend to use this simple linear model, but in economics, that usually will not hold at all. It tends to be non-linear relation, and also there are a lot more econometric problems involved when you try to fit a model to explain how these economic factors are going to affect the value of your projected liability. So it's still not required in this course, or it's not required mathematically or quantitatively, but you should have some basic understanding. That will be the starting point if in the future, if you become an analyst for DB fund. So with this, if you can choose any of these methods to characterize the negative bond within your portfolio and characterize the covariance of the negative bond with other assets within portfolio. And now you have a better understanding of the trade-off of the surplus volatility or funding ratio to how well you're going to meet the liabilities in the fund. Locate the minimum risk portfolio. That's going to be your starting point. Then the negotiation, so-called negotiation process will be involved to decide the final asset allocation for DB fund. With the benchmark relative, so far we have calculated the tracking error. So basically, that's what we have done, a data-based estimate of peer risk or tracking error. So you're usually given a time series of the portfolio performance and time series data of the benchmark, and you calculate the return difference and calculate standard deviation of the difference of the returns. So that's how we define tracking error, and this is actually, we have used this as a constraint in mean variance optimization so that we can mitigate the problem of hypersensitivity of the mean variance optimization. Actually, for private wealth management and for individual investors or for some mutual fund managers, especially if they have a clear defined benchmark, this is actually the tracking error is an important indicator of welfare. So not just from the, by looking at the information ratio of your overweight or underweight of your asset allocation, it's actually related to the welfare of individuals' perception of success or well-being or their overall assessment of their happiness from holding that financial asset. So this paper is quite old one from 1995, but it's a significant step forward for us to understand how to maximize the utility of investors from the perspective of managing the tracking error. So the model presented in the paper is something like this. They want to maximize the utility of investor, and they have characterized the utility of the investor by 3 items. The first one is the expected return from the portfolio. That's the financial assets. But here in these 2 items, they actually, the second item is the variance of the portfolio and also the portfolio risk tolerance. So the risk tolerance is usually, we can use a constant for any particular investor, or when we say an average investor. So a typical investor will have this level of portfolio tolerance. And also the last item is actually the focus of today's discussion. So here you have the portfolio tracking error variance, and here the tracking error risk tolerance. So the tracking error risk tolerance is determined by the individual investor. In most modeling practice, we can decide a range of this input or decide a number, a constant number. So for one particular investor, by asking the investor to fill in a questionnaire, you will have some understanding of the investor's risk tolerance and the investor's perception of risk, not just quantified as standard deviation or whatsoever. Here, that's the portfolio tracking error variance. That will be related, or it's a function of the tracking error. So the volatility of your outperformance relative to the benchmark. So minimizing this will result in maximized utility for the investor. So actually, this is quite reasonable to understand for investors who actually have their own mental target or benchmark. When they assess their welfare or happiness of controlling their financial assets, they actually constantly compare the performance, the portfolio of their portfolio to someone else. So in this model, this will actually incorporate this behavioral characteristic of real-world investors. So minimizing the tracking error, the portfolio tracking error variance actually tend to maximize the utility for investors who hold that portfolio. So the message from this relative risk management asset allocation method is actually provided some guidance for an investor or for mutual fund managers who have a clearly defined benchmark. It's worthwhile to work around the tracking error. So with the parametric method, you might just by looking at the portfolio at the margin. So you try to examine how the portfolio performance, outperformance or underperformance is responding to the weighting difference of different asset classes. So in this case, you're going to have better idea how you might maximize your utility, no matter you're a private investor or portfolio manager, by limiting the tracking error. But at the same time, you still have the chance to generate excess return. Next one is the fundamental risk approach. This fundamental risk approach became very popular about 15 years ago. From the message, key message from modern portfolio theory, we understand that you got to diversify and you need to, the risk of portfolio should be assessed on the total portfolio level and correlation matters. So it's basically referring to diversification across asset classes. And you're looking at diversifying your total portfolio by allocating funds into more asset classes so that you probably will have a better trade-off or better risk-return trade-off for your total portfolio. But in reality, what we are facing is something like this. If we have a balanced portfolio of 60 to 70% allocation in growth assets and 30 to 40% in defensive assets like a bond, when you run a regression of the total portfolio return and try to use the index of equity and bond as the explanatory variable, you will find that much of your total portfolio return variation is explained by the equity market movement, over 90%. So if you vary this exercise using different sample period, different markets, like in the US, Australia, Japanese, or Canadian market, you actually will find very similar outcome. So although your portfolio is 70-30 mix of defensive assets and growth assets and defensive assets, close over 90% of total portfolio variation is actually explained by equities. Why is largely explained by equity market movement? Because if you can recall last week, we had a discussion of how equity market index can be used as a leading indicator of the future economic growth. So that's the reason. There's a very much close correlation and in different markets. So when you have some exposure, for instance, a typical Australian investor will hold largely Australian assets, Australian equity, ASX 200, or hold some government bonds, corporate bonds in Australia issued by Australian companies, by Australian governments. So actually you have 100% exposure to Australian economic growth. So that is the underlying fundamental risk factor for that particular portfolio. Especially when you consider the human capital, the background assets. For example, the Australian investors' home, their investment property portfolio. Actually, you have much larger exposure to one risk factor in this context of fundamental risk context. That's the spirit of economic diversification will kick in terms of asset allocation. So this approach is usually applied after you run some quantitative analysis, for instance, mean variance optimization, and you have some output of diversified portfolio, for instance, and you try to look at the possibilities of improving the diversification of your portfolio marginally. So instead of looking at the diversification across asset classes, we look at the fundamental risk factors. For a typical balanced portfolio, the key risk factors will be the economic growth rate, real economic growth rate, inflation, and how the profits are shared by different economic participants. And in addition to that, there will be illiquidity risk, home buyers risk. So all of these might be relevant fundamental risk factors. And this fundamental risk analysis, actually, it varies across different investors and different portfolios. For Australian investors who typically owns their home as the larger piece of financial assets, they actually have substantial exposure to Australian property market, and also underlying that substantial risk exposure to Australian economic growth. So the first step to apply the fundamental risk approach is by analyzing the fundamental risk factors of the total portfolio. So sometimes this total portfolio includes background assets, sometimes human capital of the investor. And we try to understand how these fundamental risk factors are going to affect the total portfolio outcome, risk and return. The second step involves some creativity, and we try to do some asset swap. So we try to improve the asset diversification and its risk and return trade-off marginally. How we can do this? So on the left-hand side, we have this graph that's showing that we have a total portfolio at this position, and I will consider some asset swap within my total portfolio, especially I identify one asset here, that's asset A, and it can be a commercial property that the fund owns, for instance, an office building or a shopping center, and I consider this tends to be too much exposure to property market or segment of the property market. I would like to diversify economic risk of my total portfolio. I might identify this particular asset B, which is an infrastructure project. So an infrastructure project tends to offer similar level of expected return as the office building, the property, but at lower risk. In this context, the lower risk means the economic risk. So infrastructure projects are usually financed by the government or the corporation of the government or private entities. So to some extent, the risk is much lower. So the outcome, the expected return or risk of the infrastructure project is less sensitive to economic development. For instance, with the valuation or expected return of a commercial property, you probably will, it tends to be more sensitive to the real economic growth rate or the particular demand in that segment of property market. But with the infrastructure projects, which are usually financed with the government funding, they are less sensitive to real economic development in the economy. So in this way, you might improve at the same level expected return of your two portfolios, changing from the red one to the blue one, but you might have the chance to reduce the risk or standard deviation of your total portfolio. That's ideally what we want to achieve in the asset allocation. We try to improve the risk-return trade-off of my total portfolio by swapping assets to do the assets of similar level of expected return but lower risk. In reality, it's very difficult to find such an asset of similar level of expected return but lower risk, because this equilibrium, this misplaced risk-return trade-off will be pushed back to equilibrium very quickly by the market participants. So that's usually what we have in reality, that we have asset A and we swap to asset C, which offers lower expected return at lower risk, so that your total portfolio will be at much lower expected return and lower risk. But there's one inspiration that we can extract from the modern portfolio theory is actually the use of leverage. The use of leverage, which considered here, you're going to employ a hybrid approach, swapping assets from A to C, and at the same time you use leverage, you can improve your total portfolio return and risk to this point, D, so that you're going to still have the same level of expected return. Leverage tends to improve your risk-return trade-off to some extent if there's no significant bankruptcy or solvency problem for the business. And also, you have lower risk of your total portfolio. So to apply this in practice, that might involve shorting of some assets within a total portfolio to improve the risk-return trade-off. Or sometimes you might borrow money to invest in some assets, like was depicted here. So this is really a powerful method to improve an existing portfolio risk-return trade-off. This can be particularly important for your assignment. In the assignment, if you have read through the requirements, the concerns of the clients, they have very much concern of the concentrated risk of the property portfolio. Right now, it's 60% in direct property investment. So how you might diversify this risk? You might safely employ fundamental risk approach by looking at the risk-return trade-off if you're swapping into listed properties or other assets like equity, international equity or bonds. So you really have very much space to be creative on this regard. Okay, we are right on time. We'll take 5 minutes break. After the break, we'll talk about other methods very briefly. The other methods we might employ in asset allocation, like fill the buckets, it's actually like a layout, the investment universe for investors. And this framework actually builds on our understanding of alpha and beta in the industry context. That not usually refers to the alpha or beta that you often read from finance textbooks. So here the alpha is the excess return from active management of some financial assets on a portfolio of assets. And the beta exposure comes from sometimes from a passive index if it's available. And sometimes when this passive index is not available, it's actually a bundled alpha and beta together. So fill the buckets, we may employ this mental framework of asset allocation to present this to an investor, given the investor's circumstances and requirements, that what investment opportunities or investment assets are available or accessible, from the very aggressive mutual fund investment strategies to like this something that you can actually buy from the market, the passive index, or sometimes the opportunities, and you can get all of these investment opportunities. So based on this fill the buckets framework, you have a complete set of investment strategy or investment opportunities for the investor to choose from. But it does not produce any asset allocation at all. The next one is a hybrid approach of two-stage approach of asset allocation. So this approach actually recognizes that, okay, to run the standard mean variance optimization can be very sensitive and can be risky because of the uncertainty of the parameters, the uncertainty of the model. So we come up with this hybrid approach that to some degree we can mitigate or sometimes solve the problem of hypersensitivity or the uncertainty of the parameter and the model problem of a standard mean variance optimization. So given you understand the investor's circumstances, objectives, risk, preference, and also you have a good understanding of the investment universe, and the first stage will be a standard mean variance optimization. In the first stage, you're going to assume all of the equity assets on average at equilibrium level, they're going to have the same level of expected return. For instance, in the first stage, we're going to assume Australian equity, international equity, they're going to be at the same level of expected return of 8% and same level of standard deviation. That's the long-term expectation and conditional modeling technique, long-term expectation at equilibrium level. So at this stage, you either have great confidence in the data you have, or you have great confidence of forecasting for that asset's return, standard deviation, and covariance matrix with other assets within your portfolio. So in other words, it's safe to run a mean variance optimization. Much of this time series data you forecast will actually satisfy some of these assumptions of standard mean variance optimization. So at this stage, we're going to run the optimization, including the assets that you can safely or confidently forecast the expected return, standard deviation, and covariance. For instance, Australian equity, world equity, Australian bond, international bond. With these asset classes, we have very much confidence. Oh, he changed the code. The wireless is quite stable. So that's what we do in the first stage. We try to run the standard mean variance optimization, have this output from the optimization process as our starting point for the second stage. Actually, if you consider this, the whole class is given the same expected return and you work on the same simple period and you're going to adjust the returns in the same way, you end up with the same asset allocation. So that's another reason that we do not use the output from mean variance optimization as asset allocation decision. So everyone is going to have the same quantitative output because it's just the optimal mathematical outcome from this mean variance optimization process. And what actually will determine the difference between different people, their perception of risk or return, and the asset allocation, how they're going to improve the chance to achieve the objective, comes in the second stage. It can be a hybrid of quantitative and qualitative analysis. So in the first stage, we didn't include assets that are very difficult to forecast, or we don't really have much confidence to forecast. For instance, commodities. They are very volatile, and all of the quantitative analysts believe that it's really difficult to forecast commodity prices, no matter it's iron ore, oil, or whatever, gold or agricultural commodities. So if you do want to include this kind of assets within your portfolio, it's going to be analyzed in the second stage. So at this stage, you try to be resourceful, creative, and try to collect as more information as possible. The underlying risk factors, for instance, if you are examining the investment in infrastructure investment in Australia, you look at the funding from the government, you look at the projected cash flow from that project, for instance, toll road, or the freight forecast, or passenger forecast for the second airport in Sydney. So you do your thorough, robust analysis of that particular investment or asset class, and then you decide how much you want to allocate into that assets by switching some of the funds from the existing portfolio to these new assets. For instance, you believe infrastructure projects in Australia, including infrastructure projects in Australia, tend to improve the risk-return trade-off of your total portfolio, and you would like switch some funds from the government bonds to infrastructure. You're going to run the quantitative analysis in a way like what you're going to do in tutorial 5. So you run a baseline portfolio, baseline analysis of the standard mean variance optimization, and then you try to introduce a new asset, for instance, infrastructure in Australia, especially unlisted infrastructure. And you're going to impose your own expected return, how much excess this infrastructure project is going to offer on top of the bond investment, and what will be the risk, how you may characterize the covariance of that infrastructure project with other assets within the total portfolio. So this is going to be done in this week tutorial. With this additional analysis, your qualitative judgment and your quantitative analysis, and you might have better information how you might improve your portfolio risk or return trade-off marginally. And at this stage, you probably want to run sensitivity and scenario analysis as well, because with the standard mean variance optimization, it's based on equilibrium level of expected returns or unconditional assumptions. So if your investment horizon is for the next 5 years, which will actually, in Australian market, will coincide with another cycle of election cycle. So next year, we're going to have federal election, and if your investment horizon is like 3 years, 4 years, or 5 years, and it's very much worthwhile to do some conditional modeling. What if Labour government comes into power, and what if the Liberal government comes into power? They have quite different policies on multiple aspects of their how they're going to manage the economy in Australia. For example, the reform of imputation credits, the reform of capital gain tax, especially related to property market, and other aspects as well. So this will actually affect your portfolio outcome in 3, 4, 5 years of time. So the second stage will very much more like a conditional modeling. You try to fine-tune your modeling process, your analysis process, given that you have very good understanding how the economy is going to evolve, and you have a clearly defined investment horizon. For your assignment, I intentionally define that the clients are going to retire in 10 years of time. So the investment horizon is not like 50 or 40 years, it's extremely long, and you probably, in this case, you probably will take the unconditional approach in asset allocation. But in this case, they're going to retire in 10 years, and it's very likely they probably will get more risk averse when they retire, or they probably want to reshuffle their wealth when they retire, like put some money into family trust, or take a lump sum, take annuity, or whatsoever. So the investment horizon is 10 plus years, and you may consider this as 10 years. Within the 10 years, you do have the room to impose your own conditional assumptions. For instance, now they have concentrated exposure to property market. You might anchor on this and start your conditional modeling, conditional analysis on how you're going to forecast the performance of the property market relative to other assets, or you're going to suggest your clients to diversify this concentrated risk. So we'll talk about this probably in week 6 or week 8. How I'll give you some guidance, how you might conduct this kind of themed industry research and incorporate this into your assignment. So when you complete the second stage, you examine a list of things that you want to test with your total portfolio, introducing new assets, introducing leverage, or try the sensitivity or scenario analysis of forecasting different asset expected return, risk, and covariance. And then finally, you do the asset allocation decision so that there's a higher chance the investors' objectives can be achieved. So this two-stage approach is a hybrid of the standard mean variance optimization analysis and qualitative, quantitative analysis, very much based on the analyst's own judgment. Next one is dynamic strategies or lifetime asset allocation. 15 years ago, it was only emerging in the funds management industry, especially in the super funds industry in Australia. But right now, every single funds manager or super fund manager, they offer this option of target date funds investment within their super or investment as well. So the basic idea behind this dynamic asset allocation approach is to recognize that investment opportunity set changes, the objectives, risk preference, circumstances of investors do change in different time of their life. So this approach actually tends to mitigate or solve some of the major issues in standard mean variance asset allocation analysis. So in this dynamic process of asset allocation, you start investment with the fund at some stage in your life. For instance, 25. When you're 25 years old, you join the fund and your asset allocation will be very much 99% of growth assets, and 1 to 2% of your asset allocation will be in defensive assets like government bond. So that will be the asset allocation. It sort of accommodates the changes of investors' risk aversion when they get older. So when you get older, the asset allocation within your funds will actually follow this smooth gliding path from growth assets to defensive assets. This can happen. You might define this when you start the investment with these target date funds. You may define this to happen at every year on your birthday, or you might define this like the change will be done gradually, because the switching between growth assets and defensive assets involves selling and buying in different asset classes. So you might define this to happen gradually every quarter. So over the year, you will see your asset allocation changes from higher in growth assets to lower asset allocation in growth assets after a few years. At retirement, that's usually when most Australians will consider to retire about 65, 67. They still recommend 50 to 60% of the asset allocation in growth assets, because at retirement, life doesn't stop. You still need to generate capital gain, cash flow, dividends, like dividends from the equity investment to grow your superannuation. And that's actually a very important part of wealth accumulation for retirees. How can they come up with these ideas of changing from growth assets to defensive assets gradually in this way? Why some people like you, 20 years old, should invest in growth assets 100%? It came from the idea of lifetime financial advice for investors. Especially, you need to consider the background assets, particularly human capital in your asset allocation of financial assets. This graph shows us that how financial assets and the value of human capital evolve during a life of an investor, ordinary investor, will actually at very young age, like 20 or 25 years old, they have very small amount of financial assets. Much of the value of their life relies on the human capital. Now, if that's the case, to do asset allocation of the financial assets, you need to understand the risk-return characteristics of your human capital. So to characterize the risk-return of human capital, they actually called a panel of big names in finance, behavioral economics, and even psychologists. So this panel included Harry Markowitz himself, and also Thaler, the Nobel Prize winner. So this group of people, they sit together and they have the discussion, how can we characterize the risk-return of human capital? At last, they decided that human capital is 70% much like a bond and 30% like equity. It's actually not very difficult to understand. With the present value of human capital, you're going to expect to generate some sort of future cash flow at some point, but the value of your human capital does change following the general economic volatility or some particular development in some industries, if you're going to have a few careers in your life. So they decided, okay, human capital is going to be characterized like 70% bond and 30% equity. So for the total portfolio of young people, including the financial assets and human capital, they're going to recommend 100% investment in your financial assets in growth assets like equity. So in other words, you try to diversify the bond in your human capital with the financial asset investment in equity. So that's why we have this gliding path that's from 100% exposure to growth assets in financial assets for young people, and you're going to change gradually, reduces gradually to 50 or 60% when they retire. So when they retire, human capital, the value of human capital is almost obsolete. So in other words, your skills, your knowledge tends to be not that as updated as the young people, and the ability to generate future cash flow is very much limited for the average investor. Of course, this doesn't apply to everyone. So that's how the idea of lifetime asset allocation came into place about 15 years ago. Now, this is a very popular asset allocation, especially for private investors who do not have very much deep understanding of investment and risk. Investing following this glide path will actually give them the chance to incorporate new investment opportunities in their financial asset portfolio, and also provide them the changes in their portfolio adapting to the changes of their life stage. For your assignment, we don't need to consider these changes. We are trying to get some asset allocation right now. We don't consider the future changes very much. But if you do want to incorporate these dynamics of the life of investor, you're very welcome to incorporate any additional analysis or advice in your assignment. The next one is scenario analysis. So all of these methods we have discussed actually will come to one or a few outcomes of your portfolio, asset allocation, and portfolio with scenario analysis. Using the calculation ability of statistical packages, we can generate a probability distribution of asset allocation and corresponding portfolio outcome. So in this way, we may generate something like this, a probability set of portfolio outcomes. You will have a look at the dispersion and the concentration of the probability distribution of your portfolio outcome. Ideally, this will provide us some additional insights into the future outcome of your portfolio. But again, all of the parameters you throw into the model are uncertain, and they are subject to some subjective errors or the changing of future outlook of the economy as well. Okay, next we're going to move on, something that you have been confused for a while. So in the textbook of classic finance, we talk about alpha and beta. They actually mean quite different things in this course or in finance industry. So when we talk about alpha or beta in classic finance textbook, alpha means any excess returns that of an asset class that cannot be explained by a model or equilibrium model, for example, CAPM. That's alpha. And beta is just the return as a compensation for bearing the market risk. So that's what we have learned in the context of finance textbook, alpha and beta. In finance industry, and in most of the cases context of this course, we have a different set of understanding or definition of alpha and beta. So that's the industry definition of alpha and beta. And with the alpha is the active return or excess return that's generated by the superior skills or insights experienced by the fund manager. Beta refers to the return that you may generate from a passive market exposure. For instance, holding an ASX 200 index holding a government bond index. So that's the context we usually talk about alpha and beta. So in the industry context, alpha is usually very difficult to achieve, and it tends to be quite expensive. So when you try to generate some alpha for your total portfolio, you might choose to invest some of your funds with actively managed Australian equity funds. They usually charge much higher management fee, and on top of the management fee, they also charge performance fee. If the performance of the fund hits a certain target or threshold, they're going to charge more. But if you're just interested in the beta exposure, you just want to generate the passive index return, and you might choose to invest with a market index. For example, Australian Equity Index provided by Vanguard, Colonial First State, and a lot of portfolio managers. The passive products will provide you a very close match to the return from a passive market index. The beta exposure is relatively cheaper. And for example, for the Vanguard Australian equity funds, they charge only 20-30 basis points of management fee. Of course, when you invest or you try to redeem your units, you probably have to pay a big ask spread. But the fee is much lower than the actively managed Australian equity fund. The typical Australian equity funds, actively managed, they charges around 1.5 and as high as 2.5, even 3% management fee. So our conceptual framework of alpha and beta can help us in several tasks. So the first one, the ideas of alpha and beta can help us to identify the economic factors when we try to understand the underlying driving forces of some asset returns. And we might employ the CAPET model or Farmer-French 3-factor model, 4-factor model, or 5-factor model. Now we have a lot of choices. So with these models, market equilibrium models, we tend to try to understand how the asset returns are driven by these factors. Another use of this alpha and beta is actually performance attribution. And given this portfolio performance, particularly the actively managed funds, we can attribute the performance to alpha or to beta exposure so that we can have better understanding how skillful or how lucky the fund manager might be in the evaluation period. And risk modeling as well. So as we have understood from the second lecture, the funds management process is actually a process of managing risk. We only experience return. We have no discretion over the asset return at all, but we can manage the risk. The alpha and beta framework will help us to understand the risk of our portfolio coming from the alpha or the beta exposure. The exposure replication and hedging. This is quite interesting for some investors. If you're interested in the asset allocation of some hedge funds, for instance, and you try to understand how they could generate this outperformance in the past several years, and one way is to use the alpha and beta framework. So given the performance, for instance, quarterly reported performance from the hedge funds, they don't report very much detail of their asset allocation. But if you try to understand the secret of some hedge funds, you may run the portfolio return of the hedge funds against several beta exposures. For instance, an S&P 500 index, some government bond or corporate bond or high yield bond or other assets index, so that you have some ideas how the return variation of the hedge funds can be explained by this passive index or beta exposure, and to examine the R squared and see how well you fit your model. And then you could try to be more creative to include something else into your model, try to explain the portfolio variation of the hedge funds so that you can have some good understanding of the asset allocation of the hedge funds. So this technique is often used by a lot of portfolio managers, especially they try to find out the secret of the not very transparent hedge funds or private equity funds. The issues of alpha and beta in the industry context, about 20 to 30 years ago, a lot of actually the the investment products advertised in the market labeled as alpha, they are actually turned out to be some beta exposure. For instance, the small cap investment. This is very well known that size effect in recent several decades of time. But 50 years ago, the funds managers, hedge funds managers, they were advertising aggressively of selling their skills of investing in small cap companies. But if you look at the total return of the funds, most of the return variation actually explained by beta exposure and the size effect. Not really by the selection of security, the small cap company, not by the skills or market timing of the fund managers. So that's why we have this very famous, very well-known comment that a lot of alpha advertised in the funds management industry, they are just beta exposure disguised as alpha. Later on, when the financial market evolves and much of this so-called alpha, they're going to be ripped off the disguise and be classified as beta exposure. In the industry, 20, 30 years ago, the portable alpha investment strategy was quite popular. So usually in this context, the portfolio manager is given a passive index as benchmark to beat, for instance, S&P 500. And the portfolio manager will employ this method of shorting the futures, the derivatives usually, of that underlying benchmark. Because when you're shorting or buying in derivatives, it involves much less capital investment upfront, but you have the exposure to that market. And then they use the funds they have raised from investors, investing usually in unrelated market, for instance, high yield corporate bonds, to generate alpha. This portable alpha investment strategy was popular for a while, but the implementation can be quite tricky because of the involvement of derivatives, and the managing of cash flow, managing your exposure tends to be quite tricky. It has lost its popularity in recent 20 years. Smart beta. I believe any finance students so far have heard about smart beta or smart indexing. So the passive market index is simply based on market capitalization. With the smart indexing, they introduce other measures. For instance, dividend yield. Or sometimes they tend to be quite creative and do a lot of back testing and try to propose some different measure of smart, in quotation mark, smart indexing. So this can be based on franchise value. A lot of fancy names can be created from these strategies. So dividend yield, dividend yield can be one candidate, or anything like value, momentum, or other factors. For example, the Farmer French factor model. They have inspiration from the factor to rank the stock within the index in this way and allocate their funds. It's very popular investment products right now for quite a long time, especially after the global financial crisis. We have observed a very clear trend from active investment to passive investment. But there's some problem. The more investors investing in passive investment, the less management fee can be charged on the funds under management. So I believe this is partially driven by the initiative or creativity of funds managers. Okay, we offer you something different, which is actually between, sorry, not this chart. The investment products we promise to offer a higher expected return than the passive index at marginally higher fee, but much lower than the active investment products. So a lot of investors are investing in smart beta products right now. I have provided you several articles on smart beta strategies. Academics, practitioners, they have their own interest in it, especially the funds managers. They try to promote it as investment products to compensate the loss of market share of their actively managed products. They have lost a lot of market share to Vanguard and other passive products providers. So they are promoting this product aggressively and citing lower fees than the active, but it provides much marginally higher expected return than the market cap indexation products. Academics try to be critical, and they look at the thing from different perspectives. So you might want to have a read if you're interested. As academics, we don't usually have some interest into promoting any financial assets. So probably it's worthwhile to consider the thinking or advice of academics instead of just relying on the marketing materials from the funds managers. Another investment strategy is the exotic beta. Exotic beta exposure comes from the transitory, temporary market mispricing of certain assets. For instance, commodities, that what we have observed at the end of 1990s, early 2000, and these kind of exotic beta exposure, they provide positive expected returns, but have low correlation with equity index or equity market. And small cap company investment in some emerging markets can be classified as exotic beta exposure, and they have positive expected returns, sometimes even higher than the broad market index, and they have relatively lower correlation with world equity market. But in recent years, especially in the past 1 or 2 decades, this correlation has increased. So that means that the market is coming back to its equilibrium level. Other exotic beta, other products or assets that might provide you exotic beta exposure are like property market, especially global properties. And it's temporarily because of not favored by a lot of investors, that might be